Hello, this is Tim Congdon, Chairman of the Institute of International Monetary Research at the University of Buckingham. It's the middle of November 2021, and I'm once again reviewing monetary trends in the main economies. This has been for some time. I've been focusing on the USA and the inflation story there, and this particular monthly video is on the same themes. Now, we've just had the figure for the increase in the consumer price index in the year to October, and this was 6.2%. It's the highest figure for some decades, and quite a bit of soul searching is going on in the American economics policy-making establishment about what's happening here. What I want to do in today's video is to focus on the Federal Reserve, American Central Bank, and particularly on its Vice Chair, Richard Clarida, who is in effect the institution's most important economist, perhaps its chief economist. I'm going to be very critical, and my larger message is the Federal Reserve doesn't understand why inflation has increased. It's a very fundamental message, and implies that the world's most important central bank isn't really on top of events and is really in a muddle. You must judge whether what I'm saying is right or wrong, but anyway, let me proceed. I'm going to quote some length, first of all, from some remarks that Dr. Clarida made in October, on the 12th of October, about a month ago now. Let me start. This, of course, was before the 0.9% October increase in the CPI and the 6.2% annual figure. Since February 2020, core inflation, as measured by the deflator of personal consumers' expenditure, somewhat different from the CPI, let me emphasize, and that's what going to be this measure of inflation that the Fed looks at. We're going to be center of attention the next few minutes. Anyway, the core PCI deflator inflation rate is running at 2.9% annual, well above what I would consider to be a moderate overshoot of our 2% longer-term goal for inflation. This is all Richard Clarida speaking. Fully reopening the $20 trillion economy this year is taking longer and costing more than it did to shut it down. In particular, the reopening has been characterized by significant sectoral shifts in both aggregate demand and supply, and these shifts are causing widespread bottlenecks and triggering substantial changes in relative prices and wages. So we're getting towards the way the Fed interprets these events. It's all a bit of a shock, and it's all tied up with the end of COVID. And so Richard Clarida goes on to say, and now I quote again, "But I continue to believe that the underlying rate of inflation in the US economy is hovering close to our 2% longer run objective." He's saying that even though it's just been a figure of 6.2%. And to return to what he says, and thus that the unwelcome surge in inflation this year, once these relative price adjustments are complete and bottlenecks have unclogged, it will in the end prove to be largely transitory. So again, we get back to this word transitory that the Fed has been using, and other central banks has been using for some time. And by the way, this forecast is shared by the vast majority of private sector economists, including those surveyed by Bloomberg and Blue Chip. I regard this as a cop-out. It is not the job of the Federal Reserve economists to appeal to private sector economists to justify what they're doing. They should be using a method of analysis that appeals to theory, and indeed I may use this word to science. They should be using a method that is successful time and time again when tested against the data anyway. And so he goes on to say, This is again Richard Clarida to quote, "I believe, as do most of my colleagues, that the risks to inflation are on the upside." That's a bit of a change of tune, but there we are. "And I continue to be attuned and attentive to underlying inflation trends, in particular measures of inflation expectations." Now, I don't agree with him. I don't think he's attuned and attentive at all. I think he's paying any attention to the serious data and serious evidence on this subject. May I just say there's no references in Clarida's work to the quantity of money, the standard theory of price level determination economics. There's no reference to asset prices, what's happening to equity market and house prices, and indeed even more amazing for an economist who's supposed to be attuned and attentive, looking at business surveys. So what I'm going to do in the next few minutes is first of all just bring those business surveys to our attention, but let's just analyse a bit what's happened in this 20-month period since January, February 2020. Now, I've looked at the numbers at the PC deflator that Dr. Clarida is most interested in, and yes, in the period from this 20-month period to September 2021, we don't yet have the October figure for the PC deflator inflation index. In that period, it went up by 5.1%. So the average monthly increase in that 20-month period was 0.25%, almost exactly, 0.25%. And the average annualized rate of increase was therefore about 3%, not exactly the same as Clarida's 2.9%, but more or less in line. Okay. Well, let's just then look at this 20-month period. Let's look at the 3-month annualized rates of change of the PC deflator in that 20-month period. And you can see that, roughly speaking, it splits into two. In 2020, there was a period of falling prices, then a period of moderate inflation, and then in 2021, we've sometimes had this 3-month annualized rate increase gone up to about 8%. So it's not been a steady 0.25% a month through this 20-month period. Instead, it's been some very weak numbers in 2020 and an average actually monthly price gain in 2021 of 0.43% a month, which annualizes at about 5%. Now, of course, all through this period, business surveys have been prepared. So if we were to be confident that we're about to return to 2% on an ongoing basis, we would expect to see that the business surveys on the price question would be turning down. All right? That's rather obvious. To get back to where we were in 2020, the business surveys should be coming down to the kind of levels on price raising intentions, price raising expectations seen last year. So let's look first of all at the increase in prices being reported by manufacturing companies in the Institute of Supply Management survey, which is a very well-regarded survey and often thought as the most important survey that's available for the US economy. Well, here we are. October's the last value. You can see that there was a bit of a dip in the summer of 2021, but it's gone back up again to almost its peak value. And these values all through 2021 and the latest value are far, far above those values in 2020. This is manufacturing part of the US economy. Let's then look at the same survey for services. Services are far more important. You can see 2021, gentle rise. Again, a little bit of a dip in the summer, but then it rises in October to its peak value for this cycle. In fact, it's the second highest value ever for this survey, and much higher than in 2020. There is no evidence here at all of an easing of cost and price pressures in the US economy, and that is actually what Clarida requires for him to be right that we're about to see a fallback in US inflation to about 2% on an annual basis. There's just no evidence of that at all in the business surveys. There is also a small business survey prepared by something called the National Federation of Independent Business, nowadays collated and presented by Yardeni Research. In October, this had over 50% of US small companies planning to raise prices. This was far in excess of any value since the 1970s. Meanwhile, companies are also saying their hiring plans are very buoyant. They need to get more workers, and their expectations are that they will have to raise more in terms of compensation to find and keep those workers. So, look, there's no evidence at all from the business surveys that in the next 3 to 6 months there's going to be a turning down in inflation, which is what Clarida requires for what he's been saying about the inflation prospects. Let's also look at commodity prices. These aren't everything, but they say about 10% of total costs in the American economy and most other developed economies. The start of 2021, I highlighted the surge in commodity price at the end of 2020 as one reason for expecting inflation to increase. The latest numbers are not quite so bad, in the sense that the rate of increase in recent weeks and months hasn't been as great as in late 2020. However, commodity prices are still rising, and therefore they are still adding to costs at the moment. And some of those increases earlier in the year and in late 2020 are still fully to feed through. What we have to do in any realistic forward analysis, forward projection, is assume that the typical monthly rate of increase in the next few months will be at least as high as in 2020. So what I've done here is to give the annual rates of increase in the PCE deflator, assuming that the monthly increase is 0.5% and 0.6%. So till now it's been 0.43%. I'm going to use 0.45% and 0.6% because the surveys and the cost pressures and so on, all these things are showing that there's still inflation to come. And you can see that we end 2021 with an inflation number of over 5%. Obviously, with 6% a month, we get up towards 7.5% by the autumn of next year, with 0.45% not quite so bad, but between now and then, numbers of 5.5% are very common. And I think that this is the right kind of number to have in mind in the coming months. Frankly, Dr. Clarida is whistling in the wind to expect something better than that. But let's just see how we pan out. It's worth saying that the consumer price index will be reporting even higher numbers for the end of 2021. A figure of 7% is not at all implausible. Indeed, it could even be exceeded. I don't think it's true that Dr. Clarida has been attuned and attentive to what's happening to the key parts of the data. And it seems to me that frankly, the Fed has lost the plot. In our work, it's critical to look at the quantity of money. In early last year, we were highlighting the surge in money growth that occurred, particularly in the 4 months to June 2020. In that period, you had just a mere 4-month period, an 18.4% increase in the quantity of money. And the effects of that are still working their way through the economy. Milton Friedman said the lag between developments in money and inflation could be 2 years or even longer, long and variable lags. And it isn't at all surprising that following the surge in money growth in spring of 2020, it's going to be 2022 that we really see the subsequent inflation peak. We did do an analysis of this in June, which was appeared in one of these videos. And in that, we said that if the velocity of circulation doesn't quite get back to where it was in 2018 and 2019, stays a bit beneath it. And if you make assumptions of 5% growth of money from here on, then we should expect roughly a 30% rise in nominal GDP between early 2021 and the fourth quarter of 2022. And on that basis, we said we should be expecting 5 to 10% inflation really through to the middle of 2022. And that seems to me to be the right kind of conclusion to draw. You can see from this chart just how staggering that 4-month period was. This is actually what I've done here is to annualize 4 monthly rates of change in the quantity of money broadly defined going back to 1959-60, and you can see that spring 2020 explosion stands out as an extraordinary period, higher even than the inflationary 1970s. Now, I said I don't want to be unkind to Clarida personally, but one has got to make these points because he's representative of an institution and he reflects the thinking in the profession of economists in the United States of America. And what he said while this had just finished, this fantastic 18.4% jump in the quantity of money just finished in June 2020 was this. In terms of inflation, my projection is for the COVID-19 contagion shock to be disinflationary, not inflationary. This is just after that fantastic surge in the quantity of money. Core CPI is running at 1.2%, the slowest pace in 9 years. While the COVID-19 shock disrupts both aggregate demand and supply, the net effect, I believe, will be for aggregate demand to decline relative to aggregate supply, both in the near term and over the medium term. In other words, over the next few years. If so, downward pressure on PCE, personal consumption expenditure inflation, which was already somewhat below our 2% objective when the downturn began in March, will continue. His remarks made to the Foreign Policy Association in New York on the 16th of June last year. Look, you can't have a 18.4% jump in money in 4 months. The year to June 2020 was 26%, and not expect an inflationary sequel. This is just pure fantasy, and the fact that Clarida doesn't even notice the quantity of money shows what a mess the Federal Reserve is in an intellectual sense. I have to say that the analysis that I did for the Institute of International Monetary Research was very much concerned about the behavior of money. And what we said, even I could see in March, April last year what was going on. And what I said in an email in 6th of April was that the sequel to the COVID pandemic was going to be an inflationary boom. And I even said there that we don't know whether inflation will increase to 5% or 10%. Well, we don't know for certain, but I clearly implied that something of this sort was going to happen, and it certainly has. I also wondered even then whether the Fed understood what it was doing. I said actually that the return to normalcy would be accompanied by bottlenecks and supply shortages. It's all there 18 months ago. And given also that the current energy price slump may give way to energy price surge, that's happened too. An inflation figure over 10% would be a logical associate of an annual rate of money growth of between 15 and 20%. Well, I don't know, maybe we'll still get up to 10%, but I'm not pushing that as my current peak. I prefer, say, 8 or 9% on the consumer inflation, perhaps a bit less on the PCE deflator. There is obviously an issue raised by my discussion, and that is at some point, the US economic policy making establishment will realize they've been wrong They'll stop using this word transitory. They'll realize they've been wrong. And then we have to think about how they're going to react. Now, it's clearly implied by what Clarida said last month that they are expecting inflation to fall back towards 2%, say 0.25% a month less by next summer, say, even next spring. It's not going to happen. So how will they react? Now, Clarida is not a dove, if you look at his academic articles, not a dove at all. So the prospect has to be quite a drastic change in Fed policy. They're not expecting these numbers of 7, 8, 9% that are indeed very much now in prospect. The larger question here is, how will the Fed and other central banks and economists in general analyze inflation in future? They must bring in the quantity of money. Thank you.